I would like to welcome everybody here to part two of our four-part series focusing on ASC 606, the revenue recognition. So briefly, we're going to go through some introductions. I'll provide you with a NetSuite overview, and then we're going to be talking to KPMG's partner, Prasad and his expertise with regards to revenue recognition, and then we'll open it up to some Q&A at the end to cover off on any questions that you may have. So our presenters today are myself, Tom Kelly. Just briefly about me. I have been a CFO of both large and small companies. I have been a user of NetSuite for back in the days when it was called NetLedger. And now somehow I'm part of the product marketing team. So excited to do it. My focus is primarily on the financials and all the good stuff, and specifically with this key topic that we're going to be talking about today, ASC 606. And momentarily, I will get into some more details about Prasad and his background with KPMG. So just at a high level, a little bit about NetSuite, the #1 cloud ERP. We like to think we were the first cloud company. Today, we have over 5,500 employees around the globe. There are over 40,000 organizations and subsidiaries globally that run on NetSuite. And towards the end of 2016, we had achieved a $1 billion revenue run rate. We have over 13 offices. We have several offices in 13 countries. And I'm sure that many of you are aware, in November of 2016, the acquisition of NetSuite by Oracle was completed for a total of $9.3 billion. And today, we serve as a global business unit of Oracle, focused independently on the NetSuite offering, servicing our clients, and providing the best possible ERP experience that's a cloud-based ERP for anybody. So what does NetSuite do? At a very high level, in a nutshell, we're prepared to run a business, but there's certain, obviously, aspects that have to go with running a business. There's the platform that we're built on. It's a multi-tenant platform. It's built on an Oracle stack, but it's a unified data model. What does that mean? It means we are on one database. So the ability for an organization to get insights at the highest level and down to the transaction level exists very simplistically through pointing and clicking and drilling down. We also provide omni-channel e-commerce experience in addition to our ERP, our services platform, and CRM. And the point to make here is that probably the analogy I could give everybody is when you think about omni-channel, think about Amazon Prime. What we are able to do at NetSuite is we're able to primarily provide the experience for companies large and small, end-to-end, from an omni-channel shopping experience all the way through the financials and obviously revenue recognition, which we'll be talking about here today. OneWorld is our offering that provides a consolidated capability for organizations that are multi-subsidiary. The offering is multi-book. It's also multi-language, so it's provided in various languages throughout the world. Multi-currency, and also importantly is multi-currency tax compliance, which, as we all know, tends to ebb and flow and grow as with each day. And then another thing that we also focuses on is being able to provide industry focus and verticals. Our key focus in these verticals is software, services, A&P, nonprofit manufacturing, wholesale and distribution, as well as retail. Our pillars are fourfold. We have one unified system, which I mentioned. Everything is on one platform. The ability to point and click to drill down across the entire organization, the entire system. It's quick, it's efficient, and it's designed to do so built on the internet platform. And primarily, we are built to run a business. And there's obviously many components to running a business, but what's key here is that we're able to provide it on one platform across the entity. So it's not just one department. And this also includes the omni-channel e-commerce capability as well as billing. And we are global in a verticalized ERP. We can provide rich core global financials with deep industry capabilities, as I mentioned before, in terms of the areas that we focus on. So one of the, at a very high level today, there's really a 5-step roadmap for revenue recognition. Step one, we want to identify the customer and the contract with that customer. From there, we identify the performance obligations that are embedded in the contract. Step 3 is to determine the transaction price. Step 4, we want to allocate that transaction price to the performance obligations. And then finally, step 5, recognize revenue when the performance obligation is met or satisfied. So a little bit about Prasad. Prasad serves as a lead partner overseeing and managing global audit teams for KPMG. In addition, he advises some of the world's leading software and cloud companies to help them implement new business models and transformation programs, complex transactions, M&A, and capital raising transactions. Prasad was in KPMG's national office and was responsible for writing interpretive guidance, development of thought leadership publications, helping clients and engagement teams resolve complex accounting issues, and teaching technical accounting topics at training events and webcasts. Prasad also served as a national office liaison for certain KPMG clients. What's interesting about Prasad is he did spend 2 years as a practice fellow at the Financial Accounting Standards Board's FASB, specializing in revenue recognition matters, and it led to the development of the new accounting standards, which involved actively working with preparers, equity analysts, regulators, and auditors. So with that, would like to start out with our first question and ask Prasad. Prasad, first, welcome and thank you for taking the time to do this. We value your expertise and your time. First question we have is, what is the background behind ASC 606, and how is it different from previous revenue accounting rule changes?
Yeah, thanks, Tom. In terms of ASC 606, it is different than some of the historical revenue standards. Historically, the FASB took on this project. I've been living and breathing 606 for more than 8 years. I can't believe it. It's going to be a decade on this project. It's a global revenue standard. It was a convergence effort between FASB and ISB. So it is a global standard, and also it impacts various industries. So what's different is historically when we had rulemaking in the U.S., it was generally industry-driven and industry practice-driven. If you think about our 97.2 rules or even the aerospace and defense rules, so it was generally led by the industry groups and it was developed by the industry. So there was no gotcha or surprises in those standard setting. There might be 1 or 2 for other guys, but generally the whole industry there was not significant. But the new standard is much more broader and it comprises of all the industries. So you might have a knock-on effect. You might think that if you have your head down and think, hey, this is my current practice and this is our current policy, hey, this, and try to rationalize it, that's what I call it, under the new set of rules, sometimes you might be in trouble. You have to take a clean sheet of paper and look at the new rules and what is your business facts, and then how do you comply as per those new rules. So that's how I kind of put it, like why these new rules are significantly different than historical, I would say, standard setting, and this is an important standard given its revenue recognition.
Okay, thank you. All right, let's talk about some of the, in the context of your FASB experience and, the current efforts you're doing. So you said you spent 8 years working on this. I guess we're soon to feel your pain. But as far as adopting 606, can you give us an overview of the requirements for revenue and expense accounting under 606 and kind of the operational impacts it's going to have for organizations?
Yeah, so in terms of the high-level impact, I'm going to kind of highlight, in the software world, there was this notion on VSOV, that is vendor-specific objective evidence, and if you didn't have VSOV, all the revenue was deferred, and it was easy to structure contracts to get to a ratable model or to get like a different accounting outcome if you didn't have VSOV. So it was historically kind of contract-based, and did you have VSOV or not, and your accounting was driven based on that. Under 606, it is driven based more on your business facts and circumstances, and the revenue recognition depends on what is the value of the goods and services that you're delivering to the customer. And that's a big change. So you would need to think about truly what am I giving the customer, what did the customer buy, and what should be the value of those goods and services. So you're going to estimate my standalone selling price for those goods and services. Some of the more complex areas under the new standards for revenue is technology is kind of evolving. As I mentioned, this rulemaking started many years ago, and today technology is moving at a lightning speed. You have all these hybrid cloud models. When I call about hybrid cloud models is where you have software on your computer, but you also have some applications on the cloud, and both work on and off together like Microsoft 365 and others. So when you have those kind of scenarios, it is a little bit more thinking involved on what is truly the accounting model under this new 606. So if you have like any kind of business models that is kind of cutting edge, you would need to really think about what's your facts and circumstances, how do you fit in the principle, as opposed to the old rules you would use to think about, hey, do you have ESOV or not? If you're in the software world, and then your accounting conclusion was easy. Now you have to really think about how involved am I selling one solution. Some of the ways of thinking about it is my on-prem, is my hybrid cloud offering, is it a transformative in nature? If it is transformative in nature, then you might get like similar to a SaaS-based, like an over time revenue recognition model. So the other thing which people often get surprised by the revenue recognition standard is, even though it's the revenue recognition standard, it also deals with expenses. So the standard basically requires you to capitalize sales commission costs if the expected benefit from the sales commission is you're going to derive over a longer period of time. When I mentioned that benefit over a longer period of time is generally, I was in Philadelphia, it's a completely different industry group. Even in that industry group, you basically pay sales commission on a new logo. So say, for example, the new sales commission, you pay a sales guy on a new logo at a 20% of your sales contract. That gets capitalized under the new standard, even though your contract could be just 6 months or 12 months.